Good day to all. Welcome to our discussions involving investment property. Our applicable standard for this particular topic is actually Philippine Accounting Standard or International Accounting Standard, that is PAS or IAS 40 investment property. At the end of the chapter or this particular lesson or standard, we are able to, or we can actually do the following. Number one is define investment property. We will discuss as to what that is, and then hopefully we can, of course, define it. Second is in terms of initial and subsequent measurements, what shall be done, just like for property, plant, and equipment. For the model, there would be two. For subsequent measurements, it's either cost model or fair value model of accounting for investment properties. So for cost model, that is very similar to property, plant, and equipment, as well as for mineral resources or wasting assets. But what about for the fair value model? Also, account for transfers to or from the investment property classification. So it's possible that there would be some certain assets that are classified differently before will become investment property, or the opposite can actually happen. And so let's define investment property. If you talk about investment property, the property here is only land and or building, or a part of a building, or both. So if we are referring to machinery, equipment, and any other immovable property, that's out of the question and context here. So again, it's only land or building, or a part of the land or a building, or both, held by the owner or by the lessee under finance lease. Lease actually is a contract that is synonymous to rent, wherein a certain owner of the property will allow another person to make use of that particular property. So that particular owner is called lessor, while the one that is using the property is called the lessee. And this is under finance lease. What's the purpose? To earn rentals or for capital appreciation, or both, rather than for use in the production or supply of goods or services, or for administrative purposes, or sale in the ordinary course of the business. Now, this is very important to take note, because if, for example, a certain entity has land or a building that is used in letter A, I said here, production or supply of goods or services or administrative purposes, that's really PPE there. Or if that land or building is to be sold in the ordinary course of business, that is inventory. And also if, for example, the business model of the business is really for the land or building to be rented, so a company is into really leasing of their spaces, in that case, that's part of the operations of the business. So supply of goods or services. The service there is the rent or lease services. And so that would be also out of investment property. That's going to be under property, plant, and equipment. One example of that is, let's say, a building that is used for hotel services. Hotel, in a sense, would be allowing people to make use of the premises. It's like also the rent. So in that case, it's going to be part of property, plant, and equipment than of investment property. So that's IAS 16 or PAS 16. This is PAS 40 or IAS 40. We are now dividing and delineating ourselves, separating other standards with the current standard that we are discussing. Now, here is a comparison of the two, investment property versus PPE. For investment property, again, this is already explained for the first two items here. Let's go to the second. Generates cash flows largely independently of the other assets held by an entity. Purposes a while ago, rentals. So let's say The business is a manufacturing business that would produce retail products, but then retail goods, but then it also has a property as an institution or business in which it can earn rent. Or for land, they want the value, or it wants the value of that land to grow over time, and that is appreciation or capital appreciation. So in that case, there would be other cash flows that are to be obtained than the mere selling of the retail goods. So that's what we meant by that. For owner occupied property, which is also property, plant, and equipment, actually another term, it generates cash flows in conjunction with the other assets held by an entity. So example, if the land or building is used in the production or supply of goods or services, it will be used together with the other assets or PPE items to be able to provide the delivery. Then investment property would only focus again land and building or part of the building. However, the OCP or owner occupied property may include other assets, can include even the movable ones like the equipment and also machinery. So you know what I mean, guys, about that. For the standards, this is PAS 40, this is PAS 16. Then examples of investment property would be for long-term capital appreciation. We want the value of that land to grow over time, and it is not for sale. Because if it is for sale, it is again inventory. Letter B, land held for a currently undetermined future use. In accounting, intention is very important. If we do not know the intention yet, our assumption is that it is for capital appreciation as well. Whether we like it or not also, land really will grow over time with respect to the value. Letter C is a building owned by the entity or held by the entity under a finance lease. Take note that, well, this is already the lease, which is another accounting standard, but there are two types, the operating lease and the finance lease. If we say operating lease, we are just making use of that particular property, for example, the building or the land, and both. And then we are using that property in exchange of rent payments or lease payments. But for finance lease, there's a chance for us that we can consume the majority of the life of the asset as if we are the owner, or really title passes to us and we are like doing it rent to own. So we are paying and later on we would become the ultimate owner of that particular leased property. So in that case, if a building owned by the entity under a finance lease and leased out under one or more operating leases. So clearly this is going to be not the mainline operations of the business, and the purpose here is to earn rent. All right. If the building really is well owned by the entity or because of the finance lease owned by the entity, but it is leased out in a finance lease, that's going to be out already of the examples. Why? If it is a finance lease, the title of the ownership will pass to another party. So in other words, we are no longer the owner of that property. I hope that is clear. Letter C is part of investment property because the lease is operating. Letter D, a building that is vacant but is held to be leased out under one or more operating leases. All right, so that is still going to be part of IP or investment property. The purpose again is for the operating leases. And then even if it is vacant or even if it is not yet finished, but the purpose is for really the operating leases, that is investment property. Provided also, again, this is not part of the main line of operations of the business. Letter E, property that is being constructed or developed for future use as investment property. The purpose again is IP, therefore part of IP. Hopefully we'll have the list of not examples of investment property, although mentioned already. Okay, here we go. Letter A is property intended for sale. This is clearly inventory in the ordinary course of business or property acquired exclusively and then with a view to subsequent disposal in the near future or for development and resale. So this part here is really going to be similar to the inventory, and the latter one, for example, really to be developed and later on to be sold. Inventory under IAS or PS2. Letter B, property being constructed or developed on behalf of third parties. So example of these would be construction companies wherein they are paid to construct certain assets in behalf of certain companies or third parties. That's another standard. This particular standard will be discussed specifically in advanced accounting courses, but for the others could be tackled a bit in intermediate accounting subjects or courses. Letter C, PPE or OCP, owner occupied property, that's under PAS 16 and also awaiting disposal. So in that case, PPE really. And letter D, this is the one that I was talking about here in letters C and D, wherein if we leased our property to another entity, even if we accept the rent, however, the lease is financed, not operating. So in that case, that property is owned now by another entity. Therefore, that's no longer ours. All right. Here is an interesting concept or question, though. And that is, what if the property is partly investment property or IP under PAS 40 and partly owner occupied under PAS 16? If we have the portions that can be sold or could be sold separately or leased out separately under a finance lease, mean to say the portion will not affect the other or significantly affect the other. In that case, we have to account the portion separately also. So the portion that is rented out under operating lease is classified as IP, while used for the operations of the business, whether production, supply, also known as delivery, part of selling, and administrative functions, then property, plant, and equipment. Again, with the assumption that such portion that is rented out under operating lease is not the main line of operations of the business. Because if it is really organized for rent, it's still part of property, plant, and equipment. Next, what about if we cannot sell them separately? Then we have to look into certain requirements, and especially if we look into the portion that is significant. If what is significant is the production or supply of goods or services or for administrative purposes, that's really part of the definition of PPE or owner occupied property. Therefore, that's under PAS 16. However, if the significant portion is for renting out under operating lease, then that's going to be part of investment property. So for not sold or cannot be sold separately, look for the significant portion. Normally, it will be the first case or situation. Since we're talking here about rooms, in big buildings, there are rooms, there are spaces or floors that can be dedicated as for just the renting and part of the administrative and selling and production functions, meaning to say the operations of the business. Now, what about ancillary services to occupants? If we say ancillary, it means additional, or let's say main services to occupants. However, we have to know, even if it's main, even if it's really part of the operations of the business, as to whether that would be significant or significant. So ancillary, also known as, for some books, majority of the books I would say would be really mentioning that ancillary means incidental services. So to be able to perform the operations of the business and to provide and deliver the goods and to provide also or render the services, we need to provide these items. When ancillary services are provided to the occupants of a property held, the property is classified as IP or investment property if the services are insignificant to the arrangement as a whole. So example of these would be the building maintenance and the repairs, activities, utilities, support of certain staff of the building to the occupants. So in that case, the business model really is going to be the, let's say, rent. Well, that's going to be part of property, plant, and equipment. So the assumption also here is that this is not going to be the business model of renting. So it is just one of the assets independent from the main line of the business. So that is our assumption, like a certain building is just rented out. But I use the word just, but it could earn a lot or more or millions for the business. So in that particular building, if, for example, the ancillary services are like, again, building maintenance and the likes, and is significant of the arrangement as a whole, so IP. However, if, for example, the ancillary services are really significant to the arrangement as a whole, such as, again, going back to the hotel services, we're in the services of the bellboy, the chambermaids, the assist team and people who will make sure that the experience of those who will be making use of the company facilities of the hotel would make their stay enjoyable. So in that case, these services really are major components and significant components of the arrangement as a whole. Therefore, that's going to be part of property, plant, and equipment. Needless to say, if ever the services are really part of the operations, that's property, plant, and equipment, no question or doubt. Now for the measurement, initially it's cost, but subsequently, we have to use cost model or fair value model. Is this different from PPE? Yes, on the sense of fair value model, because in PPE, there is such thing as revaluation model, wherein we can make use of either the replacement cost or the fair value. That is, of course, original fair value, but here, no. Fair value really is there is an active market for that property, or if not, then similar market, or if not, then input prices using company estimates. That's under IFRS or PFRS 13 fair value measurement, which will be tackled in higher accounting courses. The following are excluded from the cost of investment property and are expensed immediately. In this case, there's something that you guys know of already, even from property, plant, and equipment. So startup costs, but if they're necessary for the intention for the property to be usable, of course, then that's going to be capitalized. Operating losses, no. And for the waste which are beyond the normal levels, they have to be expensed immediately. Also, if the waste would be normal, then such would be part of the cost of IP or investment property. Then what about for this one? This is interesting. Property interest in operating lease. If a property interest in an operating lease is classified as investment property, then all items of investment property shall be measured under the fair value model. The question is why? That could be a very important question that we can ask. This is interesting because in an operating lease, we're just given the right to make use of the property. And of course, in that sense also, it is going to be investment property if ever we are the owner of that property. But if, for example, let's say we are the owner, but we are also leasing that out under operating lease to another party, and whoever is that party that receives the leased property for use, lease that out to another entity under operating lease. So in that case, there is really a property interest. There is something financial and beneficial that is thought would provide more benefits for the entity. And in that case, so all items of investment property shall be measured under the fair value model. That's the requirement under IAS 40. Then If ever there would be a change in accounting policy, well, we are going to account that prospectively, meaning current and future periods. So whatever would be the carrying amount in the current time, that will be compared to the fair value, and the difference would be gain or loss. If the fair value is higher than the carrying amount, so that would be a gain on change of fair value of investment property. However, once we select fair value model, we cannot go back to the cost model. So that's why a change from the fair value model to cost model is not permitted. Then in determining fair value, PS 40 requires all entities to determine the FB of IP, whether it uses the cost model or fair value model. Fair values determined are used for measurement and disclosure purposes. If the entity uses the fair value model, and if cost, because we have to present that just like for PAS 16, in which the value would be cost less accumulated depreciation and accumulated impairment losses. So the fair values will have to be disclosed in the notes to financial statements. Then we have here fair value model. So after the initial recognition, an entity that chooses the fair value model shall measure all of its investment property at fair value, except in cases where the exemptions under PAS 40 applies. So remember, initial recognition cost, but after that, at fair value, if we use fair value model, then changes would be the difference of initially that's fair value minus cost, but later on it would be the fair value minus fair value, and that would be reflected as gain or loss in the profit or loss section of our statement of comprehensive income. Now, for investment property, this is the unique one. Remember, if cost model, we have to apply IAS 16, in which the cost of investment property will be updated in terms of the depreciation and impairment. However, once we use the fair value model, since fair value is the current value of a certain asset, just like investment property, therefore, we do not depreciate, because otherwise we will be in double jeopardy. So it's like we are updating plus updating. Now, if the fair value of an item on investment property cannot be determined reliably on initial recognition, such item is subsequently measured under the cost model. This is just in unusual cases wherein we cannot determine the fair value. But after that, after initial recognition, there is a rebuttable presumption that we can really determine the fair value. Although we use the word rebuttable, meaning that is still subject to debate and it's not final. It's not absolute, it is just relative. Then for cost model, we've said this already. If we use the cost model, then we apply it to all of the investment property at cost less any accumulated depreciation and impairment losses under IAS or PAS 16. What about for transfers? So as said, it can be that certain assets classifications are not IP before and now becoming IP, or vice versa. Now for change of this, it would not just be the intention. Intention is not enough, but it should be the actual use of it. So evidenced by example, transfer from investment to OCP. Example, it has been leased out under operating lease, but now the company would like to use that as part of the offices, let's say, for example, for accounting offices. So that is part of administrative purposes. Next is commencement of development with a view to sale. Example, from investment property to inventories, so to be sold already. Letter C is end of owner occupation. So from owner occupied under PAS 16 or PPE, then to transfer to investment property. So in that case, from usage of it for the operations of the business to capital appreciation or rentals, provided again that the entity is not in the main line of operations of renting out their properties. Letter D is commencement of an operating lease to another party. or a transfer from inventories to investment property. So let's say a building that is expected to be sold as part of inventories, but then changed to capital appreciation or rentals. All right, so thank you very much for listening to this particular part. Hopefully you got something from the discussions. Please stay tuned for further updates of our accounting standards. Thank you for listening, and God bless us all always.